What if everything you believe about money is only half the truth? You work for it. You save it. You spend years chasing it. Governments print it. Banks store it. Corporations move it across continents in milliseconds. But here's the question almost no one stops to ask: who actually controls it? Is it governments? Is it billionaires? Is it secret organizations hidden behind closed doors? Or is the answer something far more complicated and far more unsettling? Because the truth is, the world's financial system was not built overnight. It wasn't designed by one country or one leader. It evolved through wars, crises, deals, and decisions made in rooms the public never saw. And the deeper you look, the stranger the pattern becomes. The people you think hold the power might only be part of a much larger machine. And today, we're pulling back the curtain, not to chase conspiracy theories, but to understand how global money power actually works, who influences it, and why the system keeps repeating the same cycles again and again. Before we can answer who controls the world's money, we need to ask a more important question. What is money, really? Money is not gold. Money is not paper. Money is not numbers on a screen. Money is trust, and whoever controls trust controls the flow of money. Thousands of years ago, people traded goods directly: wheat for tools, livestock for clothing. But barter had limits. You needed a common standard, something everyone agreed had value. That's when precious metals like gold and silver became the first universal currencies. Gold didn't just shine. It symbolized stability, scarcity, power. But here's the first twist: gold itself wasn't the real power. The real power belonged to those who stored it: kings, temples, and later banks became guardians of wealth. And slowly, a pattern emerged. People trusted institutions to hold their money more than they trusted themselves. That trust laid the foundation for the modern financial system. Then came paper money, not as currency, but as a receipt, a promise, a note saying, you own this much gold stored somewhere safe. But once paper replaced physical metal, something changed forever. Governments and banks realized they could print more paper than the gold they actually had. And that moment quietly shifted control of money from physical resources to financial institutions and state authority. The story from here becomes a chain reaction, one decision leading to another, each move reshaping who holds power and who follows orders. The real origins of global money control don't start with digital banks or modern economies. They begin during the rise of centralized governments and early banking families in Europe. As empires expanded, wars became more frequent and more expensive. Kings needed funding beyond taxes. That's where private lenders stepped in. Wealthy banking families financed governments in exchange for influence and guarantees of repayment. This created a new balance of power. Governments ruled nations, but lenders influenced governments. When wars were won, lenders gained prestige and profits. When wars were lost, they often gained leverage anyway, because debt still had to be repaid. This meant financial institutions slowly became invisible power brokers behind political decisions. Then came the Industrial Revolution. Factories exploded, trade surged, economies scaled, and banks became essential to growth. Money was no longer just a store of value, it became a tool for expansion. Central banks emerged as the guardians of national currencies. They controlled interest rates, regulated inflation, and stabilized economies during crises. On paper, they existed to protect the public. But here's where the story complicates. Central banks are often described as independent. They are not directly controlled by politicians, yet they influence political outcomes. They can inject or withdraw money from the economy, affecting employment, business growth, and national stability. This independence was meant to prevent corruption, but it also created distance from public accountability. And the deeper the financial system grew, the more invisible its control mechanisms became. The 20th century changed everything. World wars began to reshape political borders, but they also reshaped financial power. After the devastation of global conflict, countries needed a new economic order to prevent collapse. This led to international agreements and financial organizations designed to stabilize global markets, regulate currency exchange, and prevent future depressions. The goal was cooperation, but the result was a network of institutions influencing how nations handled money. At first, A significant percentage of global transactions flow through a surprisingly small number of systems, not countries, not currencies, systems, credit card networks, international payment rails, clearinghouses, and financial messaging services form the invisible highways of global money. If these highways slow down, economies stall. If they stop, trade freezes. Control today isn't always about printing money, it's about controlling the infrastructure that moves it. This shift is subtle but powerful. Instead of asking, who owns the money, the modern question becomes, who controls the pipes through which money flows, and those pipes are increasingly digital. In the past, wealth was stored in vaults. Today, wealth is stored in databases. This means financial control is now deeply connected to data control. Every transaction generates information: what you bought, when you bought it, where you bought it, and sometimes even why. This data shapes credit scores, lending decisions, advertising strategies, and investment algorithms. The result: money and information are now inseparable. When algorithms decide who qualifies for loans, who receives investment funding, or which markets get attention, influence shifts from traditional bankers to technology-driven decision systems. It's not just institutions shaping economies anymore. It's software, it's predictive models, it's automated risk calculations. And while these systems increase efficiency, they also create new forms of concentration. The companies and institutions that build or manage these technologies gain enormous leverage, not necessarily by holding money, but by guiding where it goes. Throughout modern history, financial concentration follows a predictable cycle. 1. Innovation appears, a new system promises decentralization or fairness. 2. Rapid adoption occurs, people rush toward opportunity. 3. Large players enter, corporations, institutions, and governments step in. 4. Consolidation happens, influence begins to cluster. 5. Regulation follows, attempts to rebalance power emerge. 6. The cycle resets, and new innovation begins. This pattern repeated with early banking, with stock exchanges, with credit markets, and most recently with digital currencies and financial apps. At first, innovations promise freedom from centralized control, but as adoption grows, influence concentrates again, not because of conspiracy, but because scale attracts power. Large systems require resources. Resources attract investors. Investors attract regulation. And regulation shapes the next phase. The hidden truth isn't that someone secretly pulls all the strings. The hidden truth is that financial control naturally gravitates towards centers of stability and scale. And those centers shift over time. Many people assume governments control money completely. After all, they issue currency, set fiscal policy, and regulate financial institutions. But modern economies are interconnected. Governments don't operate in isolation. Their decisions are influenced by trade relationships, debt obligations, global markets, and public confidence. If a nation prints too much money, inflation rises. If it prints too little, growth slows. If it borrows excessively, debt pressure increases. This creates a balancing act where governments hold authority, but that authority is constrained by global economic realities. In other words, governments influence money, but they are also influenced by the same financial forces affecting everyone else. Corporations today manage vast financial resources, sometimes larger than the economies of small nations. Their investment decisions shape industries, employment rates, and technological progress. However, corporate influence isn't direct control over global money, it's influence over capital allocation, where large pools of funds are invested. When corporations shift investments, markets react. When they innovate, industries transform. But corporations still operate within regulatory frameworks and market pressures. They are powerful players, but they are not sole controllers. Digital currencies entered the scene with a bold promise: decentralization. No central authority, no middlemen, pure peer-to-peer exchange. For a moment, it looked like the financial system might finally break free from centralized influence, but then reality introduced complexity. Large investors entered, exchanges formed, regulations emerged, market volatility increased, infrastructure became centralized around key platforms. The paradox appeared: A technology designed to reduce concentration began developing new centers of influence. This doesn't mean digital currencies failed. It means they followed the same historical cycle as every major financial innovation before them. The lesson is not that decentralization is impossible, it is that sustaining it requires constant vigilance and balance. After centuries of evolution, one truth becomes clear: no single individual, family, or institution controls the world's money. Instead, control exists as a distributed system of influence: governments, central banks, corporations, technology networks, global markets, and public trust all interacting at once. Think of it less like a throne and more like a web. Each strand holds tension, each node affects the others, and when one strand shifts, the entire web vibrates. The system's strength lies in its interconnection, its weakness lies there too, because when trust erodes in one part, the effects ripple globally. 3 clear takeaways. Takeaway 1. Money is built on trust, not just currency. Paper, coins, and digital balances only work because societies collectively believe in their value. Trust is the true foundation, and maintaining it is the central challenge of every financial system. Takeaway 2. Control is distributed, not centralized. Financial power doesn't belong to a single group. It emerges from interactions between governments, institutions, technology platforms, corporations, and public confidence. Influence shifts, but it rarely disappears. Takeaway 3. Cycles repeat. Awareness is protection. Every innovation promises change. Every cycle brings consolidation. Understanding these patterns helps individuals make smarter decisions, avoid panic, and recognize that economic shifts are part of long-term evolution, not sudden mysteries. The future of money will likely become even more digital, more automated, and more interconnected than ever before. Artificial intelligence will analyze markets. Digital currencies will coexist with traditional ones. Financial infrastructure will become faster and possibly more opaque. The question is no longer just who controls the money. The question is becoming who understands the system well enough to navigate it, because in a world where financial influence is distributed, knowledge becomes the most powerful currency of all. If this video changed the way you think about money, share it with someone who still believes the financial world is simple. Subscribe for more deep dives into the systems that shape our lives. And comment below with your perspective. Do you think the future will bring more decentralization or more concentration? Because the conversation about money isn't ending, it's only getting more important.